good morning, and happy Friday, and welcome to Secure the Bag with, of course, me, your host, Stephanie Beard, aka Laker Girl. You guys, it is a nice day today. It is Friday, January 30th already. We're already at the end of the month. How quickly these days are moving. Today's title show is Read the Details Before You Risk. Okay. And of course, I always got to start it off, you guys, with my disclaimer. This is not financial advice. Everything shared is for education and entertainment purposes only. Please trade at your own risk tolerance. I'm just here to try to assist and help and educate. That is it. Um, so we've already learned capital gains and losses, short-term versus long-term taxes, options, tax reality, and what to expect at tax time. Now we're going deeper dive into these rules and numbers that can cost you if you ignore it. Now, remember, on Monday, I did said I was going to do a quick deep dive in the wash sale situation, the wash sale rule. Okay, the wash sale rule is an IRS rule that can block your losses. And what it says simply is if you sell a stock or option for loss and buy the same or similar security within 30 days before or after, you may not be able to claim that loss right away. So you buy a stock, for example, at $100, you sell at $80, you lost $20. You buy stock A again 2 weeks later, that loss may be disallowed for now. You don't get that tax benefit immediately. And why does this matter is because active traders get hit with wash sales because they trade the same stock often and they re-enter too fast. They don't track the dates, and this can inflate your taxable income, reduce your visible losses, and cause tax time surprises. And that's going to be something that I'm going to be dealing with, especially with silver as I trade silver. But you have to be smart and put money away when tax time comes around. This is 2026, so you don't have to worry about it until the end of this year. Now, how do you read? Let's get into how do you read the numbers that matter. You can put up the bid ask slide. Before you buy any stock, here's how to read like a pro. You mean, so bid and ask. Oh, you know what? Before you do, just leave that up there for now because I'm going to show how it looks on the platform after I read everything. Okay, so bid and ask. This is how the trade really happens. When you're about to buy a stock, and this also is with options, but we're talking about stocks. But every stock and option has two prices, not one. So we're going to start with bid to the left. Bid is what the buyers will pay. The bid is the highest price someone is willing to pay to buy a stock or option. So you're going to think of it as what buyers are offering. To the right, you see the red, which is sellers, what sellers want. That is the ask. This is the people who are selling the stock to you. So the ask is the lowest price someone is willing to accept to sell. And so you think of it as what sellers are asking for. All right. You could put up the spread. Did I put that? Oh, okay. I think it is a slide that has a spread on there. Let me look at it because you might not know which one it might be the breakdown. No. Maybe I didn't put that one up there. Okay, so just leave that one there. I don't think I put that slide up. I thought I did. So the spread, you guys, the difference between a bid and an ask is called the spread. For example, when you bid $9.95 and the seller is asking for to sell it to you for $10.05. And mind you guys, when you look at these numbers, it says $9.95, but what that really means is $995. And they're selling it at $1,005. And the spread is 10 cents, which is $10 between the price. That $10 is basically the cost of doing the trade. So why bid and ask matter? Because the tight spread, there's always a tight spread, which means it's good. It's easy to get in and easy to get out. It's high liquidity and big stocks and popular options. So the wide spread is bad. Okay. The wide spread is bad because it's harder to get filled. It costs more to trade, and it's very risky when you enter. There's also small or low volume stocks or options. Now, why market orders can hurt you? Pay attention. If you use a market order, you buy at the ask and sell at the bid. That means you automatically buy higher and you sell lower. That's why smart traders use limit orders. And we'll get into that in a minute. But bid are buyers. Just remember, bid are you, the buyer, and ask are sellers. And you can even become a seller yourself at the end of the day. We'll get into that way once you become very acclimated to buying stocks. But the spread is the toll you pay to trade. So the tighter the spread, the better the trade. Okay. The tighter the spread, the better the trade. The wider the spread, there's always hidden costs. So you got to be very careful. Reading bid and ask helps you to avoid bad fills and reducing trading costs, and it will protect your bag. All right, so the next slide would be the breakdown. The breakdown. There you go. I wish you guys might want to take a screenshot of this. So when you look to the very left, you'll see where it says volume. At the top left, it says volume. How many shares are traded? That's what that means. How many shares have traded for that day? High volume equals strong interest. Low volume equals weak interest. High volume will confirm moves, and low volume will do fake outs. So you got to be very mindful of that. High volume, when you see people buying that stock, that is good. When it has a low volume daily, it's not good to be in that stock. Oh, next to the right, where it says overnight pre-market volume, this shows trading before the market opens. So spikes can mean it's happening because of the news and because of their earnings are coming up or happening. And also big money positioning, it gives you early clues. That's why I said it's, especially as a beginner, you want to wait to trade. Give that market, let that market just ride for 30 minutes. I know, as an experienced trader though, you see it like today, silver it got as high as $107 this week. It fell all the way down to $89. That's $16, $17 difference. I lost $1,500, but I'm not worried because I know that it's going to go back up. I have till February 20th to get rid of that option. And I sold already one at a very high profit. But let's get back to this. Overnight pre-market volume. So big money positioning, it gives you early clues. Remember that. The next to the right, you see average volume. Now this shows what's normal for the stock. So compare today's volume to average. So higher than average equal unusual interest. Remember, lower than average equal a quiet day. Okay. Now you go below volume, you see where it says open. That's the first traded price of the day. It shows how the market feels overnight. The market does still trade overnight because over in China and other places, you guys, people are trading. So it shows how the market feels overnight. And then there's a big gap up or down, which equals strong emotion. Next to that, you see today's high, which is the highest price reached today, which shows how far buyers pushed where sellers showed up. Then next to that, you see today's lows. That means that's the lowest price reached today. And it shows how far sellers have pushed that price down and where buyers have stepped in. Next, you see the market cap, which is the total size of the company. That means small cap equals a smaller and it makes it riskier. Large cap is bigger, which makes it more stable. Now, the market cap will help you judge your risk level. All right, we're going to get into the 52-week high. The 52-week high is the highest price in the last year. If the price hit near its 52-week high, that means that stock is very strong. Okay, and then but may be extended. So that 52-week high is something, always look at that, because it gives you a clue of what this stock has done within that year or have done. Now, the 52-week low is the same thing, just the opposite. It's the lowest price in the last year prior. And if it's near that 52-week low, it could be cheap, which is great, or it could be weak. So you got to make sure that you do your research, and context really does matter. Then we have our PE ratio, price to earnings. Price to earnings. This is very important when it comes to reading and knowing about your company. It shows how expensive a stock is compared to profits. A high PE equals growth expectations, and a low PE equals value or problems. It helps you see if price makes sense. And of course, we love our dividends. Dividends yield, you see that. It shows how much income that stock pays. It's good for income investors and long-term holders, which you should definitely want to be a long-term holder. Not all stocks, though, pay dividends. Okay, and then next to that, you see, I believe under that, you see short interest. That means short inventory. It shows how many shares are being shorted. And high short interest means many traders are betting against that stock. And we'll get into puts, calls, and puts, so you'll know what that is. And that has to do with stock options. With the short interest, potential for big squeezes, and it can create serious problems. So you got to be aware of that. Next, you see the borrow rate. You guys should take a screenshot of this. A borrow rate, it costs to borrow shares to short. So high borrow rates means it's hard to borrow shares. It's also it also shows a heavy short pressure, and it creates high risk for shorts. And this can signal volatility. Right now, volatility is happening. Okay. All right. You can take that down, and you can get into that limit market slide there. Hang on. The limits versus market order, you guys. This is how you really buy and sell. When you place a trade, you choose how you want to get filled. This choice can protect your bag or quietly cost you money. So pay attention to this. Market order. Just get me in. Okay. A market order means buy or sell immediately at the best available price. And what happens is you get filled really fast, but not at a guaranteed price. You buy at the ask. Remember, if the ask was $9.95, you're going to buy it at $9.95, and then you sell it at the bid, which is what people, what you become the seller at that time. So what it's good for is that it's very good for liquid stocks. It's good for small position sizes, and when speed matters more than price. So that's when speed matters more than the price. And here are the risks, because there's always risk in here. There's also a risk of slippage, which means worse price than expected. And then there's also wide spreads that can hurt you. Remember, the wider the spread, the worse it can be for you. And you lose control of that entry or exit price. So your limit order is only going to be placed at your price. So you buy or sell only at that price that you choose or better. And that will actually, what happens is you control that price. And you may not get filled, but you still have that control. And there's no surprises with the pricing, and there's also better for the spreads. Okay. And it's really good for options trading. I use it all the time for options trading, and also low volume stocks. And it protects your profits. It protects your profits, and it is also going to reduce trading costs. So the trade-off is for you is that you might miss that trade, but again, patient discipline. Okay, here's a real, and I gave you guys an earlier market order, but again, an ask price of $10.20, which is really $1,020. You're gonna, and you hit buy market, you might get filled at $1,030, which is showing $10.30, but $1,030. But you paid more than you expected. So, but when you use, that's the market order. But when you use your limit order, you set that price. You control it. You set it at $10.20, which is really $1,020, and you only get filled if someone sells it for that price, and you control that price. So make sure you keep control of your buying. Don't. I never buy at market price. Only if I know that the stock is gonna definitely take off like silver. I will do that. But why pros prefer limit orders is because pros use limit orders to control entries, to control exits, to avoid bad fills, and also to reduce hidden costs, which means traders are those spreads are smarter. You are using your noodle to make sure that that trade is being used in a smart way, and you're doing it in you're taking that spread and not losing and risking your money. So speed can cost you, and you want to control and protect your bag. If you don't control your price, the market will will control it for you, you guys. So make sure you pay attention to limit orders. All right, so let's get into the common mistakes, because these are the most beginner common mistakes, you guys. Take a look at that and what it looks like after buying a stock already and it ran up big. You don't want to do that. That's one of the first ones. Buying after a stock already ran up. Do not do that, please. You will lose out. All right. By the time you see it trending on social media, the smart money is already in. So don't. The lesson is chasing. Remember, we don't chase here. We buy smart. So buying at the top is not good. Number two is over trading. What it looks like for you. It's taking too many trades out of boredom or emotion. Don't be emotional. Be calm. More trades does not mean more money. Sometimes it means more mistakes, and I've been there before. So it's always, you guys, quality over quantity. Next, ignoring support and resistance. We talked about that last week. Support and resistance is very important because it gives you the entry points and it gives you the exit. So buying that resistance, and remember, buying that resistance is not good. Buying that support is. So the most common mistake is buying at resistance. Don't do that. And then selling at support. It's the total opposite. Just remember that. Buy at support, sell at resistance. You're buying, when you buy at resistance, you're buying where pros sell and selling where pros buy. And the lesson in that is structure really matters. So making sure that you are structured when you're buying stocks. Now, again, using your market orders on wide spreads, getting bad fills on stocks, on low volume stocks and options. The spread is a hidden tax you don't see. Make sure you guys keep in mind, taxes will kill you at the end of the day. Until it hits your P&L, don't do it. Make sure. Limit orders, protect your price, control it. Control your price. All right, so the next one is not having a stop loss. We talked about that earlier in I can't remember which episode, but hoping what it means and what it looks like is hoping a losing the trade comes back. No. Hope is not a strategy. Okay, protect your downside first. Trading without a plan. You always want to go in with a plan. Entering with no entry, no exit, and no risk rule. That is a mistake. If you don't have a plan, the market has one for you. And the lesson in that is that your plan reduce emotion. Okay. Number 7, we all cannot do this. You cannot never ignore taxes. What it looks like is spreading gross profits. Gross money is not your money. After tax is the real bag. So that is your real money. All right. Next is trading. And this is a big mistake for a lot of people out there that think they could double their money real quick. Trading with rent money. Don't trade with your rent money. Using money you can't afford to lose. Don't do that. Use only money that you know. Oh, if you out there buying Jordans or jewelry you don't need, things that you don't need, that money should be in the stock market. Okay, use money you can't afford to lose. Pressure money makes bad decisions. So don't use your bill money. Don't do that. Only trade risk capital. And that's the things that you buy that you know you don't need. You probably got 20 pairs of Jordan in your closet and you know don't need another pair. All right, you guys, but most losses don't come from bad stocks. They come from bad habits. So fix your habits and your results will follow. It will follow. All right, you guys. I did have something on taxes, but I'll add that to my next one. But if you don't read the numbers, you could take that slide down. If you don't read the numbers, you're trading blind. Price alone is not enough. Professionals, you guys. I'm gonna help make you professionals in this because it took me years to learn this market deal. Oh, that's what I want you to put up. That slide is a screenshot. What did I put in there? I think I put it under, oh, here it is. Example. There we go. Now, this is the actual Robinhood platform, you guys, of what I spoke about, the details, the volume. This is how it's set up. You see the bid to the left. You see the ask to the right. This is the actual platform on Robinhood. This is how a stock, when you purchase a stock, this is how it looks. And you see the numbers there. If you want to screenshot it and then blow it up for yourself, but this is the actual platform of Robinhood of when you buy a stock, you see the volume, you see all the market orders, you see everything there. And that is the true setup of how it works. You see the ask to the left, how people are bidding on it, and that was how the sellers are. And you see the little red and the green little like candlestick or charts, pretty much like a chart. And you see the red is showing that sellers are selling the stock more than buyers are buying it. And I believe this is SoFi. SoFi is doing this again. SoFi is a scenic. It takes the scenic route, you guys, meaning that it's slow. It moves slow, and that's okay because at the end of the day, SoFi is going to turn out to be $100 stock. It's only $26 right now. It's moving slow, but that's okay. You want it to move slow. You want it to because it's going to get to where it's going to get to. All right, I'm gonna get into my my situation today is what's going on. I'm not gonna lie. This week has been totally amazing for me. The market is red, and you know what red means? It means shopping, going shopping. All the top 5 stocks that I told you guys about, those are all in the red except for SoFi. SoFi is in the green, but it's not up a lot. SoFi, oh, now it dropped, you guys. SoFi, when I looked at it this morning, right now it's down $1.02, so it's only $23.33. I'm telling you, it's the best time to buy right now. It's the best time to buy when the market is down in red. I feel good. Even though I'm down $1,523, I don't mind that because I just know that all the money that I'm down right now, I'm going to recoup it. Everything on here, even applied, APLD, I believe that's down. Let me check it and see. APLD, Applied Digital, is down $2.31 right now. It's at $35.79. Shopping days. IONQ. That is down $1.86 right now. It's $41.38. Irene, let's go into Irene. IREN is the ticker symbol. It is down $4.10. It's at $55.75. Okay. It is really a nice shopping day. Let's see what Lyft is at. Lyft is it's only down 47 cents, but it's only a $17.28 stock. SoFi and Lyft are going to move slowly. Irene and IONQ, those do move. In APLD, those will move a little quickly. So with Irene being down almost $5, if you are already an option buyer, and if you're not, you still want to buy the stock because it's going to go back up $4.38. So you're going to make money no matter what. Everything that is down today, when you buy more of the stock, you're going to not double the money, but you're going to make more than what you spent for the stock. Everything, almost everything is down. Bitcoin, we're going to get into crypto, you guys, because Bitcoin, I want to tell you right now, if you're not in Bitcoin, you can go buy Bitcoin. You don't have to buy the entire Bitcoin. You can buy portions of it. Okay. Oh, it's sold. All right. Let me see. Am I down? Oh, it's pending. Okay, because I'm in there again, you guys. See, I got to be very careful of the wash sale because I went in because silver fell down. Right now, silver is down to $89.47. That is a steal because silver went up to $107. I got 3 minutes, you guys. Silver went up to $107. You can take that down. Silver went up to $107. You cannot beat that. Even gold is down like $20 plus. $89.69. It is down $15.88, you guys. And when you look at the charts, I'm looking at the charts and I'm showing that looking at the candlesticks, sellers are winning. Sellers are selling off. Hey, sell it. Buy. And that's why I'm in it again. I still have an option left. I made over right now on silver, I am down $1,435. But that's profit. That's not even my money. That's the house money that I got. So just remember that, you guys. It's a red day. Monday, Tuesday is going to turn around. So go shopping. Be happy, you guys. It is a great day today in the stock market. People are saying, oh, it's red, it's low, I'm losing money. No, you're not. So remember, you guys, rules matters, numbers matters, details matter. If you want to trade like a pro, if you have to read like a pro, you have to read like a pro. So because this show Friday secures the bag. This is Secure the Bag with your host, Stephanie Beer, Laker Girl. Peace out, you guys. Have a great weekend. And we'll see you back here on Monday. Peace out, y'all. Hey, Stephanie Poole. Have a great weekend. I could do my outro.